Rahman Rahim. Bismillah wa Rasulullah. So this presentation, inshallah, will talk about financial awareness for Australians. This is meant to empower people to make informed decisions in the current complex monetary system. So who I am, I'm an Australian Egyptian. I have a master's in engineering. My only academic qualifications are in engineering and management. So it's just important to mention I don't have academic qualification in finance, neither in Sharia law or Islamic law. This is just important to highlight in the beginning. I lived in the Arabian Gulf in Europe before migrating to Australia, and my hobbies are theology, philosophy. I'm interested in these topics, history, economics, and sports. So my question to you, have you ever wondered how money is created? Yes, it is that tool that allows us to buy goods and fulfill our needs, but have you ever thought about where it originates? Who is responsible for making money? When you see new banknotes in circulation, does that make you feel positive, or is that a cause for concern? So it is important to think about these topics because that's basically what we're going to talk about in this session. So every new migrant who come to Australia, their main concerns are the inflation pressure is increasing. A lot of us struggle to keep up with inflation. Housing, that's the $1 million question. Should I buy? Should I rent? What should I do? Investment options, that's another thing that a lot of people, once they settle and they start thinking about, okay, what's the next step? They always think about, okay, now I'm making money, how can I invest that? Bank loans and interest, that's always the troubling question. And superannuation, for sure. So this lecture aims to explain money creation, banking, and financial systems to foster an informed financial choices. So yeah, I have a claim. My claim that people have been destined to poverty because of the modern monetary system. 8 billion people spend 1/3 of their lives working for depreciating wages. So basically, the currency or the wage that we spend 1/3 of our life, 8 to 5 days a week, we spend it in return for a wage that it depreciates. Its value decreases by time. And the wealth we generate, it increasingly concentrates in the hands of financial institutions and corporations. The inflation ensures that these wages rarely keep up with the essentials, increasing cost of essentials like housing, healthcare, education, etc. So basically, the wealthiest benefit from their appreciating assets, while others, the majority of people, they struggle to accumulate wealth due to the stagnant wages and higher cost. So the current monetary system prioritizes financial gains over societal well-being, and it's actually exploitative. It exploits people, take advantage of people and the resources of the majority of people, sustain the profit for the minority. So let's summarize what is the current financial system is based upon. So you have the central banks, and you have something called the fractional reserve banking. And then these are very important things that we're going to unpack in this lecture. And then you have got fiat money and, of course, interest-based economy. The core issues of the modern monetary system are these points: inflation and depreciation of currency, the fractional reserve banking, the interest-based lending, fiat money, and the monetary policy that is favoring the financial market. So we're going to talk about these things in details. We will delve into these concepts and unpack them so that we can understand why the today's modern monetary system is evil, exploitative, and it perpetuates systematic inequality. I always make a claim that this is one of the most evil invention of human beings. And I will prove to you how this idea of modern monetary and financial systems are one of the most evil ideas that humans ever came up with. So in this lecture, we're going to talk about these topics. We're going to talk about what is money. It might sound very basic, like what is money? I'm here just to waste my time to know what is money. But I appreciate your patience going through this lecture. It's going to make sense more and more as we go. So just appreciate your patience, and because we have to take it from the like bottom-up approach. What are the types of money? Okay, and this is going to be probably new information for a lot of us, that there are types of money. Money evolution, how money evolved across history. Fractional reserve banking, Australia's monetary system, and that's what we're going to shed some lights on to understand more the system that governs the country that we live in. Government securities and treasury bonds. This is a very, very important topic. Quantitative easing, and that's another very important one. It's actually said that a lot of us don't even know what the meanings of these words are, given that these words actually shape our life and our future and the future of our kids. And then we're going to touch upon the religious position regarding this monetary system, whether it's different Abrahamic religions. And then we're going to, quickly run onto maybe some solutions. So what is money? Money is something that has value, acts as a unit of exchange, okay, for goods. In a healthy and a fair economy, the money supply should equal economic activity. So whether it is industrial, whether it's energy, whether it is agriculture, whether it's any sort of production, trade, whatever, the fair and healthy economy is that money supply should be equivalent to economic activity. Whenever this equal sign in the middle is being compromised or being becomes less or more, that becomes a problem. So what determines the purchase power of money, which basically translates to the prices of goods and services? What determines the prices of goods and services? Is it the supply and demand, or is it only the supply of money, or is it both? So modern economics and finance, education teaches that it is only supply and demand. Banks and governments also like you to believe that it is supply and demand, which determines the prices of goods and services. But this is a big lie. Supply and demand is that which determines the price of goods and services in a fair economy that is based on commodity money or real representative money. And we're going to talk about this. What is a commodity money and what is a real representative money? But bear in mind, yes, supply and demand should be what determines the prices of goods and services, but that's in a fair economy. And I'm going to show you in this presentation that we don't live in a fair economy. We live in an evil system. Okay, therefore, supply and demand are not what determines the prices of goods and services. Because our economy is not based on commodity money and real representative money, and I'm going to explain what are those terms and what is differences. Our economy is actually based on something called fiat money, and I'm also going to explain what is that. But fiat money is money that is unbacked by commodity reserve. Okay. So supply and demand plays only a minor role, okay, in determining what are the prices. Actually, more significantly today, in this kind of economy that we live in, and this kind of monetary system that we live in, the amount of money available in the economy is what determines the prices. So there is a theory called the quantitative theory of money. It's it's a valid theory. It's available everywhere. You can see it. But in modern academia and in like banks and governments and even the financial experts, they don't want to open your eyes about this theory. They don't want you to believe in this theory or to understand it. But basically what this theory says, it says that a change in the money supply results in either a change in the price level or a change in the supply of goods and services, or both. So basically the value of money is determined by the amount of money available in the economy. So basically, if you have some economic activities, agriculture, mining, grazing, hunting, gathering, whatever, and then you have that amount of money, okay, the purchase power of the unit of currency, okay, becomes less compared to a situation where the amount of money available in the economy are fewer. That makes basically the purchase power of the unit of currency becomes more. So let's try to explain that. So you have got this much money, and you've got here your merchant or your seller selling some goods. So the price for let's say an orange or something, let's say it's an X amount of dollars. So in that economy, there's always certain amount of people who can afford buying these goods or this kind of fruit, let's say. The oranges or whatever settles based upon who can afford it. Okay, there will be some people only who can afford it, and those people, okay, will be willing to pay the price, all right, and to basically get this kind of goods. If multiple sellers offer the same product, they will compete. So they start lowering the prices to attract buyers. Okay, and this creates an equilibrium price where supply is equal demand. And of course, there will be the considerations for the vendors like production cost and viability and the profit margin and how can they continue production. Now imagine the same sort of market, but then you increase the supply of money. There is more money circulating around. Okay, where it comes from, that's another topic. But let's for now just imagine this scenario where there is more money now for the same sort of economic activity. So what's going to happen? There will be more people that have money in their hands that can afford buying that, orange, let's say. More people have now. There's nothing changed, but just the supply of money suddenly doubled or tripled. So there is more money in people's hands now. So when there is more money in people's hands, basically that process, okay, which is basically settling the price, okay, what happens is the overall demand increases, okay? But if the supply of goods, which basically the economic activity does not grow at the same rate, prices will naturally rise, okay, to restore balance between supply and demand. So that's what's going to happen, because basically the merchant was adjusting his profitability and his production means and everything, such as there is an equilibrium between his production and the demand, the supply and demand. So when suddenly more money becomes available in people's hands, that basically means more people can afford these goods or these services, and therefore the prices has to rise. And when the prices rise, that's again settles the prices. So this is just a very simple example. So it's always better in a healthy economy that you have a controlled supply of money, okay, and you can multiply your economic activity as much as you can, but without multiplying also the supply of money in the market, okay? This way, the currency appreciates and never depreciates. So we have to agree on this very simple concept for now, okay? Because everything else in this session depends on this concept, that when the supply increases, okay, when the money supply increases in the market, the money value, the purchasing power of this money, a unit of the currency, decreases, and that means that translates to the prices increase. As simple as that. So when you see prices are going up, it is not it is not actually the prices are going up. It's actually the value of your money that has gone low. So this is very important. When you see any sort of goods or services, whether it's real estate or food or petrol or whatever is going up, that doesn't mean like the value itself become more precious and like more rare, and we can't find it anywhere. Therefore, the competition is higher. It's often that the money that you have has been multiplied. There is more money now in people's hands, so that the price has to go up to balance or to create that equilibrium. And this is just borrowing one of the hadith of the Prophet. That's for this very reason, the Prophet refused to fix the prices. So there is this incident that the people went to the Prophet and asked him to set the price, fix it. And the messenger, peace be upon him, said that Allah is the one who fixes the prices. So he basically refused to fix the prices. Why? Because we believe as Muslims that the Prophet knows best, because he's been revealed upon from Allah subhanahu wa ta'ala. So he knows that a healthy economy, you should not control the price. You should actually leave it to supply and demand. Of course, government has to intervene to a certain extent to make sure that there is no exploitation or corruption, but don't fix the prices. This has to be based on supply and demand. All right, let's now get to, once we establish this, because this is again very important, okay, the supply of money in the economy is that which determines prices of goods and services. Okay, this is very important because everything else in this session depends on this very concept. All right, what are types of money? History is always the key. If you don't know history, you will not understand how your present is shaped and what gonna happen in the future. So always go back to history to understand how things actually happened and how it came to the point where we are right now. So the question was, have always money had the same form, the same shape, all through human civilizations? The answer is no. Money has evolved across centuries. It has always been seen as something with intrinsic value. So when you say intrinsic value, means something that has a value of itself, regardless of whether you liked it or not. So your opinion, my opinion, other people's opinion does not actually dictate whether this thing has a value or not. Okay? So I now explain what is meant by that. But only until a few decades ago, it turned out to be just a mean of exchange. So how did it evolve? From the ancient times, even BCE, before we start counting with the Georgian calendar, commodity money was the main form of money. Okay, until 1694, okay, that started changing, and then we had something called representative money, and from 1944, representative money evolved to something called fiat money, and then 1971, that's when it became just fiat money. We have only fiat money from that time. And then from 1990, we turned it into the digital money. So digital money, when I say digital money here, I'm talking about now that we don't have cash anymore. We deal with cards, with credit cards, debit cards, mobile apps, Apple wallets, Samsung, Google, all these sort of things. So that's how the timeline is. So, okay, what are the differences between those types of money? So commodity money is basically, so as we said, something that has intrinsic value, and that has been regarded across history of humanity to be commodity, to be gold and silver. Okay. Then there is representative money. So what is representative money? Representative money, as the name suggests, that you represent gold and silver through banknotes. So this paper money becomes a representation of the gold reserve that you have. Okay. Fiat money is when you don't have any reserve that money represents. So fiat money is only paper money, and why we use it? Because we trust it. We all agreed that we will accept it as a form of payment. Okay, so that's the difference between fiat money and representative money. They still both are paper money, but with representative money, the paper represents gold. With fiat, the paper represents nothing. So this is very important. And then digital money, as I said, this is all, it's still fiat money, except we kind of like removed the hassle of printing. So we don't print anymore. We just use numbers, digits on applications, on computers. Basically, it becomes just digits on computers or servers. Okay, so commodity money is good. Why? Because you cannot create commodity money. You cannot multiply it. You know, you can't be sitting today and then you say, okay, I had about 20 billion worth of gold in the economy, and tomorrow I have 30 billion. You can't do that. With commodity money, with gold and silver, the only way you can do that is if you found another mine of gold. You know, like you discovered another mine of gold, you had a gold rush or something, or silver, and then that's when you become richer. You know, because okay, I have more of that now. But without that, this money is always limited. Supply is always limited. That's why it is good. Why? Because we agreed that the supply of money in the economy is what determines the prices in a healthy economy. So when you have a control, when you have something that is controlled and cannot be multiplied, that ensures in itself that inflation becomes less. So the prices will always settle based on supply and demand. How about representative money? Representative money is good. However, under a condition that you cannot create it without limits. So you have to have measures there to control the printing against the gold reserve. And I'm going to show you how we actually started this whole evil, corrupt system when we had little control over representative money. Okay, so it is it's in the idea in itself was good, was necessary at some point in time, but it was not controlled, and that's why it evolved to what we will see next, the fiat money. Fiat money can be created with very, very minimum limits. Okay, so and it causes inflation, because if you can keep multiplying and creating money, okay, through whatever process, we're going to delve into these processes in this presentation. I'm going to explain those processes, but that's basically the main disadvantage of fiat money, that there is very, very less limits. It's only the government policies, okay, that determines how and when you create those money. Okay, and when you have a government that does not fear God, what happens is that they do not have control over, do not have limits. So they just keep creating and creating. And what happens then is inflation becomes worse. And now finally with digital money, or I'll call it the digital fiat money, because sometimes digital money can be referring to something like crypto and those untraditional kind of currencies. This kind of money is disastrous. Those Apple wallets and Samsung wallets and credit cards and debit cards, disastrous. This is like the worst form of fiat money, and we're going to explain that, inshallah. So this is just a quick comparison, just defining what are the commodity representative fiat digital, but we'll go through this in detail. So commodity money, let's start with commodity money. So intuitively, humans have thought for long that gold and silver coins should be serving as as money, as basically mean of exchange. Okay, why? Because gold and silver just happen that they are basically have characteristics, unique characteristics that made them ideal for this purpose. So gold and silver, they have intrinsic value, okay, due to their physical properties, such as their beauty, their durability, their utility in crafting jewelry and other tools. They are rare, okay, so they're naturally scarce, like they're not found everywhere. They're durable, okay? They're divisible. You can cast them, or you can basically shape them how you want. They are portable, okay? You can carry them. They're universal. They're accepted everywhere. So you go anywhere, you show gold. Gold is gold, you know? And they have historical precedence and malleability. However, they were at some point when the economy started expanding, they were impractical for large transactions. So moving heavy metals in bulk was inefficient. There was security risks as well. So transporting those, you know, valuable items posed the risk for of theft. And of course, with expanding the trade routes, especially in the age of exploration in between the 15th and 17th century, that actually increased the demand for more practical means. So what happened is representative money started evolving, okay? And it began gaining traction in Europe, especially in England in the 17th century. So the goldsmiths are the ones who were always responsible. The goldsmiths are the equivalent of banks today, okay? So they were people who were trusted. People would go there and keep their gold and silver in their vaults, okay? And they will pay a fee, okay, for the goldsmiths to keep and secure their gold and silver deposit. So what happened is the goldsmiths in London started issuing receipts for gold deposits, okay? And that eventually became the first form of banknotes. So what happens is, instead of people always dealing with gold, what they happen is then when they went to the goldsmith said, okay, I'll give you this promissory note, okay? This promissory note, if you anytime come back to me or give it to someone and that person comes back to me, okay, I will give them equivalent of this promissory note. It's called promissory because it's a promise that whenever you come back to the goldsmith with that note, you will take your gold back or you take your silver back, okay? That was basically the main idea of issuing those, they call it receipts, okay? And why did it work? Why this idea worked? Because people trusted it, okay? So goldsmiths were, and the early banks were trusted to safeguard gold and issue receipts for equivalent values. And they were convenient. So people thought like, okay, why do I need to always go back and redeem the receipts for gold if everyone else accepts those receipts? So what ended up happening is people just started circulating those receipts. They became so popular, so trusted, that people rarely went back and claimed their gold. So everyone trusted, okay, now I don't need to always go back and get the gold from the goldsmiths. We can still do business and do profits and trade and everything, okay, using those receipts, as long as everyone trusts those receipts, okay? I will only take it from you because I know that if I go back to the goldsmiths and present it, the goldsmiths will give me gold, okay, equivalent to what is in that receipt. And what happened is it actually started transitioning to more widespread use. So governments started endorsing those promissory notes, and they start issuing their own paper money. And that was the start. The start was with the establishment of Bank of England in 1694. So that was the idea when we transitioned from commodity to paper money, okay? And it was initially a mean or an instrument to make people's life easier, okay? But it ended up being used to exploit people, and it ended up being the most evil idea ever. And I'll keep repeating this, and I'll explain. You see through this presentation why. So paper money. So as I said, there's two kinds of paper money. There's representative money and there is fiat money. And the fiat money can be divided into cash and digital. So we explain the difference, but end of the day, I want you to know that paper money is nothing but piece of cotton linen paper. We just agreed that it is acceptable form. It's not really, actually, it's not really we that we agreed. It's actually the government decree. The government decided and made us accept that we spend 1/3 of our lives in exchange for this. But if you think about it, paper money is nothing just but only tree or cotton plants. Okay, it's just being refined and into bulb, and then we created a durable substrates like polymers, and then we print designs on it, and then we added some security feature, and then cut it and start distributing it as banknotes. So you need to think, how did humanity come to accept a rectangular piece of pulp tree to be something that you spend 1/3 of your life working for? I know this sounds very, very like basic, and it's like, what are you talking about? Like, all right, you know, it is what it is now. This is how the system is. You know, why are you making such a big deal? Like, I don't think you're giving anything of substance here. But believe me, I'll show you how this is actually significant. Okay, because you will see now that we are being now victims of this idea. Okay, that we just went with it and it evolved and it feels natural. We are born into this system. I was born in 1980s, and I was born, and then this was the currency used. Okay, there was the paper money. I didn't live to see the gold coins being exchanged as a mean of exchange. Maybe people older than me have, but I was born into this system. So a lot of us will not be actually questioning this, but I think we should, and I'll tell you why. In 1787, George Washington, he wrote to someone called James Boyne, who was I think the ruler of the Rhode Island, and they started issuing those Rhode Island pound, which is basically just a banknote. And he said paper money has had that effect in your state that it will ever have, to ruin commerce, oppress the honest, and open a door to every speech of fraud and injustice. So let's see, how did it evolve from representative to fiat? So in the beginning, you know, money was created as we know it today, okay, through new bank loans. Okay, so what happens is the goldsmiths or the banks, okay, they create loans, and these loans, okay, became the mean how paper money is being created. So what happened is that deposits that was received by the goldsmiths, okay, they became accepted by the general public as means of payment. Okay, so those deposits issued by the goldsmiths become accepted. But then what happened is the gold and silver itself remained unclaimed. Nobody was going back to get the gold and the silver. So the promissory notes or the receipts became more popular, and that people trusted them and rarely claimed their gold and silver. Okay, at that time, the goldsmiths or the bankers made a discovery that changed the world. They could make loans by writing out new receipts. Okay, and then those receipts later became banknotes, and the control of this monetary system, okay, becomes in the hands of those goldsmiths or the central banks. So what happened is gold and silver transitioned into something as we call it promissory notes, which is a promise to pay, and then that evolves to banknotes. So the goldsmith was sitting there, and he noticed that people don't claim their gold. So what they had of this idea, which I said they changed the world. They said, okay, what about that we start issuing promissory notes with no equivalent reserve? So it basically notes that we just create, we write those notes, and then we start issue them to people who are interested to borrow money. Okay, so those notes that the banks or the goldsmiths start issuing, they were unbacked. They did not have any reserve of gold. They were just notes that the goldsmiths decided to print or issue. Okay, and then the borrowers will come, and they will give them those notes. And those notes, when they take it out and they start dealing with them, they will be accepted because people accepted those notes. However, bear in mind, those notes were not backed by any gold, by any reserve. This is basically the goldsmith used his exclusive authority and the trust that people had in him to start issuing those notes that are unbacked by a reserve. But not only that, they decided that they're going to charge interest on top of that. So basically give it to a borrower. That borrower has been scammed, okay? And everyone else in the market has been scammed by this move, because I had money that equaled something, that had a certain purchase power. Now there is more of that money, but there is no equivalent activity that happened on the other hand. Okay? So what happened is, as we explained in the beginning, the purchase power of those notes becomes less because there is more in people's hand of those notes. Okay? But not only that, they actually charged interest on those borrowers. So they kind of deceived them twice. And that's when the idea of modern banking was created. That is basically the moment when that system we live in, okay, the moment that idea shaped the modern monetary system. And that's how we've been rolling for almost 300 years. I hope you are happy, but let's keep going. It's gonna get more interesting. So in England, 17th century, that was the first ever central bank was established, which is the Bank of England. Okay, and when that happened, the goldsmiths or the banks transitioned from being actually safeguards that you pay them because they keep your gold reserve safe. It transitioned to a service where they actually want you to come and put your money in their vaults, because when you put more gold and more reserve in their vaults, now they can issue more of those unbacked promissory notes or bank notes. So that becomes it actually became reversed. Instead of you paying them to safeguard your money, now they pay you to come and put your gold and your silver, okay, so that they can start practicing more this malicious act of issuing unbacked paper money or receipts. And what happens today with banks? It is just not. It's nothing different. It's still the same. It's still they're doing the same the same thing like our friend who was the goldsmith, who was doing or came up with this evil idea. They issue notes from the thin air, lend them to borrowers. Borrowers work their bums off to pay back that loan, and on top of that, they pose interest on them. And that's when that will open the gate for something called the fractional reserve banking. And I'm going to explain that in more details. But let's just put a pin on fractional reserve banking for now. And let's continue with the historical evolution of money. And then we're going to go back to the fractional reserve banking. So money evolution. So let's look closely in the historical timeline as relation to the monetary system. So we're talking now about modern history, okay? So in 1694, as we said, that was the establishment of Bank of England, all right? And then in the 1870, okay, about 200 years later, there was an establishment of the gold standard, okay? And I'm going to talk about this in details. But up until now, it was fine, okay? There was some goldsmiths that was doing this malicious act. They paid attention to this about 200 years later, and they said, you know what, we can't keep doing this because we are fueling the inflation, and this is evil. So we have to have a law, okay, called the gold standard. So you cannot, any bank, central or non-central, you cannot issue notes or receipts which is unbacked by gold. And that's when they had a rule or a law called the gold standard. But then when Europe engaged in World War I, okay, they had to stop the gold standard. And why that? Why is that? Because warfare is always costly. You need to basically start funding your military. You need to have wages and salaries for the soldiers and pay the wives at homes, feed their families and give them, buy weapons. And it's always costly. Wars, and we see how wars, especially the wars in Europe, have actually shaped this system that we live in now, and the whole world now has to pay the price for some European adventures and God knows what. But yeah, this is another topic. Don't want to get into it so much, but yeah, European wars was one of the main reasons why we have this system that we have today. So because of the warfare and the destruction that happened in the World War I, they had to stop the gold standard. But then World War I ended in 1918, and in 1919, just a year after, the US reinstated the gold standard. So Still, they realize the gold standard is very important. They still know that they cannot have a prosperous, fair economy for people without having some sort of a standard that basically limits the ability of money creation or money supply in the economy. But then in 1928, the Great Depression happened. And when just the Great Depression ended, okay, World War II started with Hitler. And that was even worse, because from 1939 until 1944, the World War II costed Europe and the world so much. So when that happened, in the end of this Second World War, there was something established called the Bretton Woods Agreement. I'm going to talk about this because this is very important. And then the whole world, okay, was running across or according to this Bretton Woods Agreement from 1944 until 1955. 10 years later, Americans had another adventure, the Vietnam War. And then 1971 is towards the end of the Vietnam War is when Nixon Shock happened. And I will explain what are those events and why they are important, why we need to talk about them. Okay, so as we said, the first idea of having centralized an authority that have the exclusive right of issuing those receipts, that was 1694 in England. And then 1870, the gold standard was created. And they said that basically the monetary standard under which the basic currency unit is equal to and can be exchanged for a specific amount of gold. At that time, in 1870, in the US, the Congress passed the Gold Standard Act, which fixed the price of gold at 20.67 per ounce. Okay, so that was the fixed price. That's why it's called standard, the gold standard. But then the wars in Europe. The wars in Europe exacerbated inflation as governments printed large amounts of unbacked money to fund the military expenses. And this expanded the money supply beyond what commodity reserve could support. And that degrades money, the currency value degraded. Especially we talk about the second and the first and second world wars. There was a lot of wars happened during that time, but these were the two major wars. Just to give you a little bit of an insight or perspective here, put things in context. World War I, the total cost of World War I was about 186 billion, up to 186 billion. Okay. The cost, that's at their time. In today's time, it's about 3.2 to 4.8 trillion dollar. Okay, so that the cost as of the 2024 USD. World War II, another more costly war, about 5.74 trillion dollars. Okay, so you talk about the total in less than 40 years. Okay, total amount of 10.5 trillion dollars, which is the cost of the war. Okay. And you can see here, those expenditure categories are like the armaments, the logistics and supplies, the infrastructure, the research and development, even reconstruction after the war ended. They needed to rebuild Europe from a lot of European countries or cities. They needed to rebuild it from scratch. Who was paying the cost for that? So the gold standard stopped, as we said, okay, but then they reinstated that until 1944, when we had the Bretton Woods Agreement. So what is the Bretton Woods Agreement? This is very important, guys. Towards the end of World War II, all countries in Europe, especially in Europe, they had their gold sitting at the United States vaults. Why? Because the United States was actually the biggest winner from this war. They kept selling goods and services and military aids and weapons to the European countries, the fighting European countries. And at that time, the exchange was in gold. So France and Germany and not Germany, but France and England and all these countries went to the US to get from them weapons, okay? And they basically pay them gold, and US give them corps and weapons and etc. etc. So the US had they say 50% of the gold around the world was at the US towards the end of World War II. So what was this agreement? This agreement was that 44 countries met at Bretton Woods in New Hampshire to design the new international monetary system. Okay, and that's the system that shaped the world from that point onward. Okay, so you see here in this graph how the British pound, the German mark, the Italian lira, the Japanese yen, all they were convertible to the US dollar, and the US dollar is convertible to gold. So basically, the agreement was like you can't buy or exchange in the global market. You cannot change British pound to gold. You have to exchange it first to the American dollar, and then from the American dollar, you can convert it to gold. Okay. So basically, if you just give you very, very like quick, a quick like put things in context here. 1944, when that agreement was done by the US, the gold price per ounce in USD was $35. Okay. Today, in 2024, the gold price per ounce in US dollar is 2,636. So I just want you to see the difference. Okay. In 80 years, almost 80 years, the gold price has doubled more than 75 times. 75 times. Means what? Means the USD dollar has been depreciating at a rate of 5.5% per year since 1944. That paper that we all spend our life working for it, depreciates every year by 5.5%. It is important to understand what happens in this agreement, because the United States, they were the ones who basically shaped this agreement. Okay, the other countries, those agreement, other countries just agreed to what the United States said. Okay, so the U.S. Treasury representative, someone called Harry Dexter, he was the instrumental in drafting the agreement, and in that agreement, it actually included the formation of the International Monetary Fund, the IMF. Okay, and it's very important because it becomes the instrument or the tool through which the United States controls the economy of the entire world. Okay, the US used its position as a military and financial powerhouse to push for agreements that would strengthen its post-war influence. So what happens is the US had nuclear weapon when they nuked Japan, and they had their troops, okay, their military troops on the ground, and they had the US dollar, okay, with the Bretton Woods Agreement and the International Monetary Fund. And that basically became the way how the US controlled the world, became the superpower that controlled the world. It was using economy by threatening other countries through warfare, through nuclear power, okay, that we going to establish the monetary system that is going to control the world. So all your currencies means nothing unless US agrees that it can be converted to US dollar, and then they will set the price for gold. And they started then posing interest and doing whatever they want to do, because it's all now becomes a exclusive authority of the US politicians. It's interesting because there's when, like in the last 5 years or so, some countries want to get rid of that domination of the US dollar and start having an alternative where they can, not being servants and subordinates to the Americans. So they came up with something called the BRICS, okay, where they want to create a alternative universal currency, okay, where these countries can make trade within themselves. And you notice here Russia and China and India and Brazil. And Brazil is interesting. Brazil is one of the countries that kind of have not been dominated by the American politics. And when I made some research around the fractional reserve banking, I found that Brazil was actually one of the good countries who have been kind of resisting this sort of practice for long. 80 years later from Bretton Woods Agreement, still the Americans will not allow anyone to try to move away from the US dollar. And here, this is a very recent tweet done by Trump. He said that the idea that the BRICS countries trying to move away from the dollar while we stand by and watch is over. We require commitment from these countries that they will neither create a new BRICS currency nor back any other currency to replace the mighty US dollar, or they will face 100% tariffs, and that's not, like basically threatening them. It is. They just control the world through the US dollar, through agreements that have been done, and they just backed it by military and by nuclear power. And that's what with the world that we live in now. Talking about the IMF, there's a lot of things to say in IMF, but I want to keep track of time. I don't want to, I want to cover most of the points I want to cover here. But basically, the IMF now is nothing but, if you can look at, it's nothing but a bank, okay? And countries are those who takes mortgage loans, okay? So think about it. You are a person, okay, that wants to, you have some deposit and you want to buy a house and you don't have money, and you want someone to lend you money. So you go to the bank, let's say the CPA or something, and you ask them to give you a loan, okay? And the bank give you the loan and then puts interest and enslave you for 30 years of your life to pay back, okay? That's basically the same thing as the IMF. The IMF does exactly the same thing. And instead of you as an individual, it is the countries, okay? And I'll tell you why, because, and this is going to be, I'm not going to talk about this in length, but happy to give more information for those who are interested. But there is something, it's called the special drawing rights, okay? Special drawing rights. This is according to the constitution of the IMF. It is some sort of a, let's say, privilege, okay, that the IMF gives to the member countries in the IMF. So it is allocated by the IMF authority, okay? And in short, those SDRs, okay, is what later on translates to something which is basically the money that the IMF keep lending to other countries, okay? But where does this money comes from? This is what I want to tell you, and I'm happy for you, whoever wants to challenge me after that and want to have a one-to-one conversation. But basically, this money is money that the IMF creates, does not take it from Germany, does not take it from US, does not take it from other country. They create it. They create this money using something, an article. Is called Article 8 of, I think this is Article 8, if I'm not mistaken, of the IMF Article of Agreement, outlines the provision related to the allocation and use of SDR. Who makes that decision? The executive board of the IMF. These are the ones who makes the decision about how much money we're going to create. Okay? So if you think that the IMF takes money from those, like, well-off countries that are well-off economically or financially, and then give it to the, like the poor countries in Africa and Asia and in North and South America, etc., I'm sorry, you are wrong. They don't take from the rich and give the poor. They are not doing that simply. They just print that money and they enslave countries and control their policies and their laws and their monetary system, and they pose interest. So they make sure that they are enslaved in these debts forever. And in short, this is the same thing. This is more money circulating in the economy. They're creating more money and giving it to other countries. It's nothing but the same concept that we spoke about initially. It fuels the global inflation. And if you see this amount of the SDRs, okay, that the IMF was issuing, you see that in August 2009, there was worth of 21.4 billion of SDRs, okay? And then after this global crisis that happened, the financial crisis, it increased by additional 182.6 billion. This is just money that was created from the thin air. Okay, October 2014, it became 204. And during COVID, there was some calls to increase it by another 4 trillion. Okay, so Bretton Woods agreement. Okay, America dominated the world. They now have this agreement where all currencies pegged to the American dollar, and only the American dollar is convertible to gold. Shall they stop? No. They engaged in another war, the Vietnam War. And another 176 billion was the cost of that war. And you can guess who paid that cost. Of course, not the American people, not the American economy. So this is just a timeline of what happened. But in 1971, they realized that this situation is so bad, and they basically cannot keep that standard, okay, that they had, that the US dollar should be convertible to the gold. So in 1971, the president of the United States, Nixon, announced something which was later known as the Nixon Shock. What was the Nixon Shock? It was basically the declaration of fiat money. He basically effectively dismantled the Bretton Woods system and transitioned the global economy to fiat money. So that means what? It means suspension of the convertibility of the US dollar into gold. So there is no more gold equivalent for the money since 1971 that the US government print. No equivalent. It basically just removed that tie. That link between money and gold was not there anymore, 1971. And by the way, do you know why it's actually called fiat money? Fiat, the word fiat money comes from the Bible. Fiat comes from the Bible. So in the book of Genesis, Sefer Takwin, there is this in I think it's in the third verse, when according to the Bible, God said, "Let there be light." He said, "Fiat lux." Fiat means "let there be." Okay, so it's basically represents like a creation by decree, like God say something, kun fayakun, be and it is. Okay, or let it be and it is. So they actually borrowed this word and they named the money that was in the system since 1971. They called it with the same word, let be or let there be, because it doesn't take anything. It's just the government needs to sign a paper, say today print 200 billion, and $200 billion will be in the economy in the next day. As simple as that. So that's basically what happened. It's a decree or edict from the government. They say be and it is. So from 1971, the concept of money changed completely, and that changed the world that we live in forever. And by the way, after the collapse of this agreement, Bretton Woods, some countries then wanted to go and get back their gold, because there was like, okay, now your USD dollar is not even convertible to gold. So my money equals nothing. Basically, you control the value of my currency, okay? Because it's no longer pegged to anything that is tangible. You know, there is no commodity, there's no reserve. It's just basically the government, the US government decree. What they decide affects lives of people in Japan, in England, in France, in you know, around the world. So a lot of countries went back trying to claim back their gold from the Americans. But the Americans basically resisted that, okay? And all the attempts and efforts by nations to use gold to stabilize their reserve post the Bretton Woods was largely unsuccessful due to the US resistance and the global pivot to a fiat currency system dominated by the dollar. So we spoke a lot about history. I spent almost more than half of this session talking about history, which is always important. But now let's get more into finance. Let's talk about fractional reserve banking. I want to talk now about what are the mechanisms for the government central banks to create fiat money. Okay, so now you kept talking about creating money. Okay, but there must be mechanisms. Yes, there are mechanisms. And those mechanisms are those 5 mechanisms you can see there: fractional reserve, special drawing rights, government securities, quantitative easing, interest rates, adjustments. Let's talk about fractional reserve. So what is a fractional reserve? Fractional reserve, simply, okay, this is just like an extract from an article, but this is how it can be simplified. When you have finally saved 800,000 deposit to buy, sorry, not 800, 80,000 deposit to buy your 400,000 house by selling your time for 38 hours per week, guess what happens? You go to the bank, you give them 80,000 and you tell them, I want 320,000, okay, to go buy the house. What happens? The bank according to the fractional reserve banking law, allow it to create those $320,000 on the spot, which you then have to pay back plus interest for the next 30 years. So I know that this is going to be a bit shocking, okay? Because when I spoke to people about this concept, they usually don't get it from the first instance. Like there's like, no, that's not what happened. You basically take the money from someone else's savings or deposit and you give it to someone else. The bank doesn't create money. The bank just takes this money from that person and give it to the other person. And I'm going to explain why this is not the case. But in short, what happened, okay, is that it's a cycle. All right, it's a cycle. This is just explaining the, but I want to be a bit more going faster here. Okay, so yeah, you say that the bank through this lending and borrowing is the mechanism through which money is created. That's wrong. Banks don't issue money. Neither they have the authority to do so. It's actually the authority of the central bank. And you would also say, okay, in an angry face, I know some of you have this angry face now saying, and also you say that banks create new money from deposits through this lending and borrowing. Okay, this is not right, because my proof, someone would argue, if everyone goes to the bank and try to get their money back, what happens? The banks goes bankrupt. Okay, so this is a proof that the banks do not print additional money, because if they do, then they can give everyone their money. All right, okay, I get you, and I'll explain. The key word about this that answer your question is digital fiat money. Okay, the banks don't lend cash, physical cash anymore. The banks, they create digital money and credit it into your account in the system. Okay, so when the bank gives a loan, it does not hand out physical cash, but instead it credits the borrower account with new deposit. And that new deposit is essentially digital money. It's just numbers on the system. What happens, it increases the total money supply in the economy. Okay, and with this fractional reserve banking, which basically says that the banks are only obligated to keep only a fraction of the deposits, okay, in their accounts, in the reserve, okay, and then they can lend out the majority of that money, okay. So they keep only, let's say if the fractional reserve requirements is only 10%, that's all what the banks need to keep in their reserve, okay. And then what happens, they, as I said, they create that 80 or 90%, okay, of that money. They create it. They don't take it from your account and lend it to someone else, because you see your money in your account still the same. Okay, it didn't change. What happens is that they create it digitally in the system. Okay, so why when everyone goes back and demand their money, the bank cannot pay? Because the money has been credited, okay, has been lent out or tied up in loans with others. And only a fraction of that deposit is kept as a reserve. So when you go back and you demand your money in cash, the bank doesn't have cash to cover all of these demands. They don't simply have, because they have created digital money, so much of a digital money created in the system that is not equivalent to the cash money that is existing in the system. That's why they struggle to pay everyone, and then the banks go bankrupt. So let me double down on this. I'm just going to show you some stats. The Australians' major banks earned 17.6 billion in profit from owner-occupied home loans during only 2023-2024 financial year. 17.6 billion. Okay. Let's look at the top 7 profitable companies in Australia. The top 7. Okay. The top 7, 3 of them are the 3 miners, the 3 big miners, Rio Tinto, BHP, and Fortescue. These are miners. Okay, you understand why mining is profitable in Australia. But then you look at the other 4, they are the big 4 banks. That was the most profitable organization, okay? And if you look at their ranking by capitalization, the CPA comes as number 1, 239 billion in capital. And I don't know if you know that, but these banks, the biggest shareholders are two financial institutions, American financial institutions called Vanguard and BlackRock. Okay, so basically all the money that these big four Australian banks have, it's mostly going as a profit for American institutions. So in short, what happens when you deposit 100K in the bank? Okay, the bank depends on their fractional reserve requirements. Okay, it could be, if it's 100%, the banks have to hold 100% and cannot lend any money. So basically that creates zero extra money in the economy. And that basically is the best scenario for the inflation, because you're limiting the supply of money. But what if it is 90% fractional? Then the bank can only lend 10K, 10%, which is only 10K of that money. And that's still a low inflation. But what if it is 10%? Basically, they can lend out 90K and so on. The worst thing, which is actually the system we live in today here in Australia, is you have zero fractional reserve requirements for the banks. So you put 100K in the bank then can go and create 100K to lend out to other borrowers. And that's what makes actually inflation extreme. The whole concept about this, it just relies on the assumption or the hope that not everyone will claim that their savings at the same time, which is called the bank run. This is the whole idea is just based on that we don't go and claim our money from the banks. What justification they give by this sort of evil system? They say this is the only way that we can have economic expansion or growth. Because if we just depend on the gold reserve, we can't give loans to other businesses, and those other businesses cannot make, cannot start, and not every business will have all the money to, open like a new shop or a new, like clinic or whatever. So they say this is the only way we can do it, and becomes the main mechanism for us to grow the economy. That's their claim. Actually, it is, as I said, it is the why it is bad, why this practice is bad, because this is the main cause of inflation. Okay, especially if that deposit money and loan money are paper fiat money. But it's even worse, as I said, if it's a digital fiat money. Okay, let's talk about the system that is followed in Australia. It's going to be a bit of just a double down on the concept of fractional reserve. But in Australia, fractional reserve used to be called statutory reserve deposits. Okay, and that was a law that basically obligated banks, okay, to maintain a certain level of reserve, so they can't lend out all the money that they have. Okay, in 1988, Bob Hawke, okay, which was the Australian Prime Minister under the Labour government, he basically abolished this law, the statutory reserve deposits. Okay, and that was basically him aiming to modernize the Australian economy. Okay, so what was the numbers then in the economy after 1988? Pre-1988, okay, if you deposit 100,000, the bank doesn't hold it but use a portion of it. Okay, so they must keep a small portion as a reserve. Okay, and then they take that amount and they use it for lending process to create more money in the economy, and that was basically called the money multiplier effect. Post 1988, there was zero statutory reserve deposit, so banks don't even have the obligation to hold $1 of the deposits. Okay. All right. This is just a step-by-step explanation of how this works. Okay. How when you go and you deposit money, how that money basically goes into this cycle of lending and borrowing, and how does that results in more liquidity or more money supply in the economy. And how they do this process, there are certain concepts going to be a bit more, I think it's going to be an overkill for this session to talk about those things, but it's mechanisms like the open market operation, overnight repo market, discount window lending. It's all things that the RBA regulates how this system works. But in short, what I'm telling you is that this is how it works, okay? That the government have this system, okay, of basically using lending and borrowing as a mechanism for banks to create more credit in the system. And because now it is just only digital numbers in the on like balance sheets. Okay, in banks, it's no more cash. Okay, it becomes much easier for banks to implement this idea. Now let's get to another very important concept, which is government securities and treasury bonds. So what are the government? Because this is another mechanism, okay, through which governments print money, called government securities and treasury bonds. So what are the government bonds? Okay, these are debt security issued by the government to support the government spendings and obligations. Okay, so as I said, it is simply a debt. Okay, but how these actually affect us? Like what is the what's wrong with that? What is wrong with the government issue security bonds? You're ready for some numbers? Let me give you some numbers. So Australia, its gross government debt, okay, currently as of 2024, it's around 921 billion. In about 2 years, it's expected to reach to 1 trillion. You've got other countries like Canada 1.7, the United Kingdom 2.8, France 3, Germany 2.6. New Zealand is actually good. They have only 198 billion. But look at the US, how much they have. 35.9 trillion. Means they are what do you call it? They are the kings of issuing treasury bonds. Okay. I'm going to show you something about America, but for now, I want to show you some numbers related to Australia. So in 1990, just 2 years after the Bob Hawke abolished this SDR, there was a total of $310 billion, Australian dollars, circulating in the economy. In 1991, just 1 year after, there was another extra $12.3 billion created and circulating in the economy. Okay. The RBA has only created 1.4 billion in notes and coins of those 12.3 additional money that was created in 1 year. So who created the remaining 10.9 billion? Exactly. Those were the banks through mortgage loans and business loans and personal loans. Those loans that the banks were creating, this what create another $10.9 billion in the economy. So going from 310 to 10.9, this is inflation. This translates in land prices going up, houses are going up, everything, cost of everything is going up. And this is basically what I'm telling you. The banks are the answer. Through, the idea of credit or liquidity, they inject into the economy new money by lending and borrowing through these mortgage loans and business loans. And this is basically legally backed by the government zero fractional reserve monetary policy. This is an extract from letters that was sent by someone who had some financial background, trying to interrogate the RBA about this amount of money that was created. And he basically was saying, like, you need to stop this. You need to go back to full reserve banking. You cannot let the banks be the most like the biggest winner from this, because you're not acting for the favor or the interest of the banks. You should be acting for the interest of the Australians. But is that the worst mechanism ever, like those security bonds? No, it's not. Let me talk to you about what happened during COVID. Something called the quantitative easing, and this is more troubling. So we talked about a fractional reserve and how the idea of lending and borrowing create more money in the economy. And we talked about those government securities and how governments can just create securities, okay? And those securities just become a debt. And I'm going to explain that when I talk about the quantitative easing. So what is the quantitative easing? The quantitative easing is typically digital money that the banks, central banks, create to buy government bonds, okay? So the government issue bonds and the central bank create those money digitally to buy those bonds, okay? And that is what is called the quantitative easing. So during COVID, there was no economic activity going around. People were locked up in their homes, and there was productivity just decreased to the bare minimum. There's no economic activities, no production. Nobody was interested in buying government bonds and securities during COVID, okay? Central banks, including the US Federal, Bank of England, and even the RBA, they decided to implement aggressive monetary policy during that time. So they engaged in the quantitative easing, okay, by buying large amount of government bonds and securities, okay. And by purchasing those assets, the central bank increased the money supply. And that's how they managed to pay people for 2 years, pay them wages while they're sitting at home doing nothing, okay. This money is not a debt for future generation. This money is a debt for you and me. We are going to pay back this money, and we actually started already. So I'm going to try to explain it through this graph. What happens with this quantitative easing and the government issue bonds, and then the central bank buy those bonds, print money to buy those bonds. So the government issue those bonds, okay? And it goes into something called the primary market, where there is some investors, okay, through auctions and stuff, they go and they buy those securities. And so they buy it from the government. So this is existing money. So the government get money that is existing, okay? So far, there's not a problem. Then those who bought those securities from the primary market, they go and they sell it and trade it in something called the secondary market, okay? So now it becomes more open market where other banks can go and buy those securities, okay? Still, that's all existing money. And then those who take those securities, okay, they basically, the RBA participates in this secondary market. The central bank, the Reserve Bank of Australia, participates in this market, and they go and they buy back those security and treasury bonds. But how do they buy it? They buy it with new money, and that's money called the quantitative easing. Quantitative easing. It's a new money, so it is rather just a direct. You could just simplify and say the RBA issue new money to buy the bonds that was created by the Australian government. It goes through two markets, primary and secondary. Some people buy and they post interest, and they buy and put interest, etc., etc. They make profits. It's all just a malicious, evil cycle. Eventually, what happens is those bonds, the government issue them. It's just papers they signed by the government. They issue them. The RBA prints money, go and buys those bonds, and that's how they inject money into the economy. Okay, so those money is printed digitally. It's all on those systems, on those computers. But what happens? It increases the cash flow in the economy. And I say cash flow means the amount of money circulating in people's accounts. And that makes what happens? That increases the prices. That's basically the reason for inflation. Because your money value is depreciating. You go to sleep, the government issue treasury bonds. You wake up, your money that you worked for in your week has actually decreased, okay? And it's the percentage how it's decreased or depreciates. It just varies according to how aggressive the government is following those mechanisms or employing those mechanisms. So just going to give you some numbers to understand what happened during COVID. So pre-COVID, Australia did not have any quantitative easing, okay? That was one good thing about Australia. Australia never engaged in this malicious practice of issuing quantitative easing. During COVID, from March 2020 up until September 2022, Australia issued $281 billion of quantitative easing. That's how they were paying people while they're sitting at their homes doing nothing. And those like JobKeeper and JobSeeker and all this rubbish. So 224 billion were actually direct Australian government bonds, and then there was about 57, which was state and territory government bonds. Look at the United States. This is the as I said, the biggest player in this malicious game. $4.3 trillion before COVID. This is what they actually money that they issued through this quantitative easing and securities. After COVID or during COVID, these 2 years, they issued additional 4.6 trillion US dollar. 4.6 trillion. Okay, this is like more than the money that they have created throughout history. They created more than that money only 2 years during COVID, and that's why I'm telling you now, we live in this time now, which is unprecedented. The policies and the practice that the government has followed in these last 2 years of COVID is a game changer. I'm going to play this video for you here. This is President Nayib Bukele, I think. He is the president of El Salvador, and he was giving this speech in the United States in early this year. I'll play this video for you, and I want you to listen.
Symptoms that are even more difficult to diagnose. For instance, the financial situation of the United States. When I talk to my conservative friends right here, they always tell me that the problem is high taxes, but they're wrong. Of course, high taxes are extremely high here in the United States. I give you that. You're right in that. But that's not the real problem. The real problem is not the high taxes themselves, but the fact that they are not even really funding the government. Not even those high taxes, higher than a lot of places in the world, not even those taxes are really funding the government. So who's financing the government? Government is financed by treasury bonds, paper. And who buys the treasury bonds? Mostly the Fed. And how does the Fed buy them? By printing money. But what backing does the Fed have for that money being printed? The treasury bonds themselves. So basically, you finance the government by printing money out of thin air. Someone could ask, well, so if the government can print the limited amounts of money out of thin air, why do they collect taxes? I mean, in theory, it would make sense, right? If they can print unlimited amounts of money, why would they need taxes for? The answer is simple, but it's very shocking. The real problem is that you pay high taxes only to uphold the illusion that you are funding the government, which you are not. It's shocking, but it's true. The government is funded by money printing, paper backed with paper, a bubble that will inevitably burst. The situation is even worse than it seems, because if most Americans and the rest of the world were to become aware of this farce, confidence in your currency would be lost, the dollar would fall, and the Western civilization with it.
He's basically saying the same thing that I was saying. And bear in mind, this guy, he did something that is a bit unique that no other government has done. And I'll kind of try to touch upon that in the end. Anyway, I think I've gone past the time that I allowed. If you bear with me, I'm going to wrap up this presentation, but I think it's very important. Sorry, I did not present this before, so I didn't really know how much is going to take me to finish it. So okay, where I was here. All right. So the quantitative easing during COVID, I'm talking about Australia here. Okay, in November 2020, the Australian government printed $100 billion. Okay, it was an initial target. They printed $100 billion. Then a few months later, another $100 billion. And then from July 2021 to November 2021, they printed $4 billion per week during that time, which added up to a total of $81 billion. Okay, that equaled in the end $281 billion of quantitative easing the government printed during COVID time. Okay, that made the government's gross debt to exacerbate, to grow higher. Pre-pandemic, June 2019, Australia's government debt was approximately 542 billion. Post-pandemic, after we bounced back from this pandemic, the gross debt grown to 894. So almost 350 to billion in less than 2 years. It's ridiculous. In 120 years, the Australian, because the RBA was established almost in 1900. So 1901, something like that. So in 120 years, took us 120 years to accumulate a debt of 542 billion. And in only 2 years during COVID, we accumulated another 350 billion. It's amazing. It's amazing. That's why I tell people, some people tell me, oh, like, why you make such a big deal of COVID and what happened during COVID, just only a few months and we are past it now, and like, don't talk about COVID anymore. No. That what happened in COVID, it's going to be something that I don't know if the global economy and the Australian economy is ever going to be recovered from it or not, because of these stupid, malicious government practices and policies that was followed. So if you think that this 281 billion are debt for future generations, I'm sorry, you're wrong. This is a debt for you and for me, for us Australians, and for the future generation. Just to give you a snip of how the real estate or property prices actually was affected by this, look at this chart. This is all data that I have all the sources for it. Just all, like official data from those forums concerned with real estate and stuff. But look at like December 2019 to December 2024. Look at the percentages. Some cities like Sydney, 20%. But look at Brisbane, Adelaide, and Perth. We talk about 60% and 62 and 68%. It's amazing. It's amazing. It's something that, people say, oh, why like these cities, the prices has gone up so high? And there's, of course, a lot of factors. A lot of those cities has been influenced by the same thing. It's not different. But of course, some cities other than or different than other cities because of, they attracted maybe more people and there was a bit of more like the supply and demand factor. But in general, that's constant across all is the money that the government printed during those 2 years. So let's get to the last thing in these types of money, which is the digital money. And this is very important. I want you to pay attention, because the money, the way that we are using now in doing our transaction and buying and selling and transferring money, it's helping the government implementing those policies that's actually exploiting us and enslaving us and making us poorer. And I'll show you, explain to you how. So when the bank lends the money, as I said, it does so digitally by creating in the borrower account, which immediately require the bank to hold more physical cash. Okay. However, if the borrower or the lender requested physical currency, the bank would not have enough money reserve of actual bank notes to fulfill those withdrawals. Okay. So what happens is the banks have some constraints that they only keep fraction of their deposits as physical cash. Okay. And this could cause what? If a lot of people went to the money and say, hey, we want our money, we want it in cash, what's going to happen? There will be a liquidity shortage because the physical currency available might not match the money that the banks have. Physical currency, okay, would basically need the banks when there is a higher demand for physical currency. That would obligate or require the banks to maintain higher reserve of cash. And this could limit the bank's ability to lend. So when the banks cannot lend because they're always cautious that people will go and demand their physical cash, then that money multiplying factor will basically be reduced. Okay? And that's what the banks don't want. And that's always they live with the hope that people will not do that because people trust the system. So when people trust the system, they don't go to the bank and demand their money in cash. So the banks are happy. They keep lending, they keep doing this lending and borrowing. And through this process, the banks are accumulating wealth and our money is depreciating while we are asleep. So basically, how this is actually how the banks manage this, how the RBA manages this. They always have something called the ratio of physical to digital money. And this is a ratio that the RBA adjusts with the banks, okay? But basically, the adjustment of this ratio, it basically decides how much money you can create, okay? And the physical money that the RBA actually prints and we can use to circulate among us, how does that relate in ratio to the money that is in the system? They're not the same. The amount of cash that we have, when you sum it up, it's not adding to the value, adding up to the value of the credit that is in everyone's bank account. So you need to be careful. This ratio, they are sleeping, the banks and those evil institutions, and we're conspiring with the government against us, okay, as people. They sleeping and feeling okay because this ratio, they know that they can maintain it, and people are not demanding their cash. And that's why they keep making everything digitalized, and they want to push people to be more using digital fiat money, okay? The system is largely designed to function with digital money because of the low cost and high efficiency of digital transactions and the way they can actually manipulate us without us knowing. So maybe it is the time to revert back to cash. I don't know. I'll leave it up to you guys to decide. But in a world where borrowers and lenders demand physical cash, the money multiplier effect would actually be reduced because of the ability of the banks to lend would be constrained by the need to hold enough physical reserve. So again, go back to the governance, how the different kind of money, different forms of money, okay, can be governed, can control, okay? As I said, with commodity, there is limited amount of injection of money that you can inject in the government, in the market. With representative money, it's high if the strict policy is set about issuing of those promissory notes. So you can have a stronger grip over your inflation, okay? And it's medium if the control measures of issuing notes are a bit relaxed, and it's very low if there's no supervision. With fiat money, you don't really have a lot of control, a lot of governance, okay? Because the banks can keep creating those fiat money, on the spot. And with digital money that we are using today, there is no governance, there's no control. So they can do whatever they want. And as I said, this is important now because this is when it's gonna be, okay, this all you're talking in abstract, okay? Now we wanna talk actual issues. It's something called the time preference, okay? Time preference. What is time preference? It's a concept in economy. Time preference basically say when a transaction involves postponing part of the payment to a future date, the lender or the seller incurs an opportunity cost, okay? The potential benefit they forego by not having immediate access to the fund, all right? So basically when you have a future transaction payment, like installments or a loan or whatever, okay? There is something called a time preference. So basically why there is a time preference? Because the system that we have now, the currency depreciates every day. Every day, the value of the currency depreciates. So what was the $1 getting me today, okay, is not gonna get me in a week or in 2 or in a month or whatever. So now time becomes of a value. Time now has a value, has a cost, and that is called time preference, okay? And that became basically something that is integrated, or it becomes like an integral part of the transactions, bank and trade and everything today. Time value of money, that's the time preference. Assert that a sum of money today is more valuable than the sum or the same sum in the future. And because of that money creation mechanism, which is the modern monetary system that we live in, the modern money depreciates every day, okay? Because every day there is a new amount of money injected into the economy without real economic activity. How? Because it is through the banks lending and borrowing, making money, causing us to be poorer and poorer. So in short, today, $10, if we say today $10 can get you this carton of eggs, okay? Tomorrow, with this system, the $10 will get you maybe half of that. So basically today, your money, the value of your money gets you X purchase power. Tomorrow, your money gets you less than X purchase power. And this is all happens through this cycle that I told you about. Basically, someone goes to the bank, they have a deposit, they put it in the bank. The banks take that money, and then because of the zero SDR or fractional reserve requirements, they can create loans, okay, on the spot and issue it to another person. The other person takes that money and goes and deposit it as a mortgage deposit for another bank. And the other banks take that money and then multiply it to create another loan to goes to another person. And it goes on and on and on and on. And this is all money being multiplied. Money that's been injected into systems through this concept of mortgage loans, which is what governs all the current modern economy in the Western world. So basically, just to put it simple like that, the electronic and digital money is creating from the thin air and enters the system. What happens is the banks and the financial institution gets richer and richer. But the value of the money that you earned and work it for has actually depreciates. And that means what? Means that prices rise and your affordability falls. And then you becomes a poorer person with no fault of yours. You go to work, you do what you're supposed to do. You're not sleeping, you're not lazy, you're doing what you actually should do. But the system that isn't there makes you poorer by default. That's why I'm saying it's one of the most evil inventions of humanity, okay? This fractional reserve and this idea of creating money by doing lending and borrowing, it is so evil. But who are the winners from this system? Of course, they are our friends here, the banks. And I want to give a special tribute to the most integral bank in Australia today, which is the ANZ. The ANZ was engaged in a scandal for its basically its president. That was something that was reported only like a month ago. And because of that scandal, that guy, the president of Elliott, Shane Elliott, okay, his take to home pay would fall from 4.6 million to 4.1 million. That's his annual salary. It's gonna fall by 500K, the poor guy, from 4.6 million. For God's sake, what kind of work, okay, gets you $4.6 million annually if you're not a head of an institution that is a fraud, is a scam, is scamming people and is causing them poverty and sucking their blood? That's the only way you can pay 4.6 million for a guy by sitting just on his desk and signing some paper or some checks, okay? And of course, his short-term bonus will be cut from 2.3 million to 1.2 because he is engaged in a scandal. Should be put in jail, not to decrease his salary to only 4.1 million. The poor guy. You know, there's other news about the ANZ that I found on the internet related to that. They want to scam other small Pacific Island countries around us, but the governments there are not happy with their practices, and then they're threatening them to withdraw from the market, etc. Anyway, so interest payments, okay? With this fractional reserve banking, the unpacked money creation and overall monetary policy that shapes our life today makes what? Makes money loses its value day after day. And this made time equals negative cost. So the people would rather have their money today than tomorrow, because tomorrow the same money will buy less. And this is called a time preference. Therefore, every service or good that involves transaction that happens fully or partially in the future becomes subject to the time preference. And therefore, interest payments become integral part of all future transaction and deferred payments. In a fair trade and transaction in which there is neither harm nor reciprocal of harm, some sort of compensation for future reference for the time preference is needed when dealing with fiat money. And that, think about it. Like now, if that's a system we have to deal with, if I actually give you money today and you return it back to me tomorrow, the same amount of money, I have lost. I have lost because my money doesn't buy the same anymore. And that's actually a fulfillment of a prophecy the Prophet Muhammad ﷺ made 1400 years ago. He said, there will come a time when there will be no one left who does not consume usury. And whoever does not consume it will nevertheless be affected by it. So think about it. If there is now a usury that is basically controlling the governments, the central banks, the businesses, the organizations, individuals, can you really brush away the dust of usury from yourself? This is a legitimate question. Because when whoever comes to you and say, oh, we can't do Islamic finance, we can do a Islamic funding, okay? I would be questioning this, and I'm happy to, spend the rest of my life trying to get an honest and clear answer from that person who makes that claim. How on earth are you going to make a Islamic practice that is free of usury with this system? So, in summary, in today's world, the banks create money on the spot from the thin air, and you give 1/3 of your life to assign value to this worthless money that banks create. Not only that, but you also pay the banks an interest. And if this is not evil and exploitative, then what it is? I really miss the Murabi, the days of those Murabis, al-Murabun, those usurious people of the gold old days. Because in those days, the usury, the riba, okay, that the lender or the seller was giving you something that they own. There is actual value there that they have. They give it to you, and then they take advantage of your difficult financial situation by demanding payment of principal plus interest, because they are, giving you that allowance of time to pay back your loan. But that was actually they giving you something that they own. It's a real commodity money. In this modern monetary system, the banks and the government conspire against the people to lend them fiat money. They lend us fiat money that doesn't have any, they create it from the thin air, while simultaneously devaluating the money through the monetary policies and legislations, from the back door. They give it to you from the front door, and from the back door, they are devaluating this value of the money. And on top of this, they demand interest payments on the borrowed funds. And when you as an individual, okay, you try to safeguard your wealth against depreciation and inflation by maybe go and buy some like commodity or buying something that has an asset, okay, they further burden you with taxes like the capital gain tax, and they discourage any efforts that you make to preserve your financial stability. So I hear you now. You're gonna say, all right, so what am I supposed to do now? Okay, I heard you. What can I do? And I'm going to tell you, you just do the right thing. And I know you say, okay, you just make it so dark. I don't know, like, okay, what shall we do now? All right, before we talk about any solution, I think I only have 10 minutes to go, because this is going to be 2 hours session, which is very long. I appreciate everyone's patience, but I think it's very important. We get to the solution part, and I'm not claiming that I have solutions, but I'm just going to propose what actually seems to be, the only thing that we can do as a society, as a state, or as individuals. But before, let's look at the religious views about usury, how religions talk about usury. So in Judaism, you have in the book of Deuteronomy, Sifr al-Tathniyah, you have this very interesting text saying to the Israelites that you may charge a foreigner interest, but not a brother Israelite, so that the Lord your God may bless you in everything you put your hand to in the land you are entering to possess. So in Judaism, you are not supposed to charge interest on your Jew brother, but if non-Israelites, not even Jew, non-Israelite, you can charge interest. It's distinguished between lending to Israelite and to a foreigner. In Christianity, actually, there's a lot of verses about Jesus when he went to the temple, and he was so angry. He went there to worship, and he had to pay tax in specific currency. And the money changers who was sitting at the temple, and remember when Jesus came, he came to the people, the sons of Israel, so they were sitting in the temple, the place of worship, exchanging Roman or foreign coins for the currency, often at unfair rates, profiting excessively. And he was so angry with that. According to the biblical scripture, he actually turned the table in anger. So he was condemning the practice that was happening there. How about in Islam? Let's talk about this a little bit and its importance, because I know now everyone says, okay, now this is my background. I want to act upon the values and principles and the philosophy of Islam. So the Islamic jurisprudence or legislations, basically the fiqh of the tashri'ah in Islam, it promotes justice and prohibits exploitation and harm. This is very basic concept. It encourages charity, fair trade, ethical spending, wealth circulation to ensure social welfare and economic equity. And on the other hand, it prohibits usury, riba, wastefulness, practices that exploit or harm individuals and society, ensuring that wealth is safeguarded from unjust practices. And we all know the objectives of Sharia, of the Islamic law, maqasid al-Sharia, there's the 5 objectives. The 5th objective of them is protection of wealth. So Islamic philosophy encourages you to be charitable, to give charity and do fair trading and ethical spending, but at the same time also encourage you to safeguard your wealth. So, but there is also a very important overarching principle, which is there should be neither harming nor reciprocal of harm. La darar wa la dirar. And this is a very famous hadith in the books of Ahl al-Ilm. And I just attached here a reference for that book. La darar wa la dirar. So basically, you should not harm others, but also you should not reciprocate harm or cause harm to yourself. So the prohibition of exploitation and harm, okay, there is a lot of verses in Quran that talks about that. وَلَا تَأْكُلُوا أَمْوَالَكُمْ بَيْنَكُمْ بِالْبَاطِلِ. Do not consume one another's wealth by unjust means. And this is basically manifestation. This is a manifestation of these verses, what we live in today. It's other people eating, consuming other people's wealth by unjust means, which is basically, I'm talking about the government and the banks. And on the other hand, it promotes justice and benevolence, which basically encouraging charity and trading. Allah subhanahu wa ta'ala always encourage people and commend those who spend their wealth in God's way. And there is a lot of verses that promotes this idea. From the lens of Islamic philosophy, money, the form of money, is gold and silver. That is how Islam wants money, okay, form to be. The money form in Islam should be commodity, should be gold and silver. But the Islamic jurisprudence argues people, however, to treat money as a mean, not as an end. And this is very important. This is very important. So Islam, when you choose a form of money that you use, okay, to do trade as a mean of exchange, you need to use something that has intrinsic value, that is in itself has value, not because the government said it has value, not because of a government decree or edict. You choose something that is actually intrinsic value, has intrinsic value. However, when you start to work and do trade and collect money, you don't treat it as an end goal of itself. You only treat it as a mean of exchange. That is the Islamic philosophy. Okay, not the other way around. Not that you deal with something like fiat money, use it as an exchange, and then you work for fiat money. You put all your life for fiat money. You start to, it's actually what we do is the exact opposite of the Islamic philosophy. We do the exact opposite thing. We choose the money that is not the correct form of money, it's not commodity money. We agreed on this fiat money, okay? And then we deal with it as an end goal of itself. No, money is not an end goal. Not an end goal. Islamically, money should only be a mean of exchange. But when you choose it as something that has intrinsic value. And there is the verses that talks about that in the Quran, always talks about al-dhahaba wal-fidda, gold and silver. So as I said, again, Islamically, money's form should be something that has intrinsic worth, gold or silver. However, it should not be treated as an end or as a goal in itself, but as a means to achieve higher purposes, such as fulfilling one's needs, supporting others, and worshiping Allah. So the money should be selected such as it's a commodity that has intrinsic value. Money, however, should be treated as a mean, not a goal. So spending from what Allah has given you in the way of Allah is one of the greatest virtues. And consuming one's other wealth by unjust means, such as taking usury or riba, calls for severe punishment from Allah. Those punishments actually in Islam are not like any other thing. So there is this hadith of the Isra and Mi'raj, when the Prophet ﷺ said that he ascended to the heavens and he has seen those people who eat the money of the orphans unjustly. He said, قال ثم رأيت رجالا لهم بطون لم أرى مثلهما قط بسبيل آل فرعون يمرون عليهم كالإبل المهيومة حين يعرضون على النار. قال قلت من هؤلاء يا جبريل؟ قال هؤلاء أكلة الربا. So they are the worst place in hell is reserved for those who consume people's wealth and do usury. And I argue those are basically the governments and the financial institutions of today who are exploiting us and our money. They're eating our wealth. And then the Quran goes on about basically the virtue of spending from what Allah has given us. It's in the front, in the top of the Surah Al-Baqarah. Okay. الذين يؤمنون بالغيب ويقيمون الصلاة ومما رزقناهم ينفقون. They give from what have been provided to them. And in the other verse, in verse 177, talks about those who gives money though dear. وآتى المال على حبه ذوي القربى واليتامى والمساكين وابن السبيل. ومثل الذين ينفقون أموالهم في سبيل الله كمثل حبة. So it's all encouraging people about spending from what Allah has given us. So we don't treat money as a goal in itself. We treat it as a mean, okay? And the best of us, the more virtuous of us are those who spend it in the way of Allah. But on the other hand, Allah subhanahu wa ta'ala is giving us those warnings and showing us the destiny of those who does not do that or eat or consume the wealth of people. Says, إن كثيرا من الأحبار والرهبان ليأكلون أموال الناس بالباطل ويصدون عن سبيل الله والذين يكنزون الذهب والفضة ولا ينفقون في سبيل الله فبشرهم بعذاب أليم يوم يحمى عليها في نار جهنم فتكوى بها جباههم وجنوبهم وظهورهم هذا ما كنزتم لأنفسكم فذوقوا ما كنتم تكنزون. And in the other verse, Allah subhanahu wa ta'ala talks about the riba, and it's the language that's been used in those verses. It's unmatched in the Quran. فَإِن لَمْ تَفْعَلُوا فَأْذَنُوا يَا أَيُّهَا الَّذِينَ آمَنُوا اتَّقُوا اللَّهَ وَذَرُوا مَا بَقِيَ مِنَ الرِّبَا. Forgo what remains of usury. مَا بَقِيَ, what remains of usury. If you are believers. فَإِن لَمْ تَفْعَلُوا, if you don't take notice of war by God. فَأْذَنُوا بِحَرْبٍ مِّنَ اللَّهِ وَرَسُولِهِ. The better questions become, in the monetary system where money has taken an un-Islamic form, by moving away from commodity to fiat money, in a monetary system where money multiplication becomes the governmental sovereign decree, in a monetary system where banks digitally create money through the process of lending and borrowing while charging interest, in this universal system where currency depreciates is inherent, and the concept of time reference becomes not a choice, but an integral part of every transaction, when businesses cannot operate without borrowing from banks and individuals, how could a financial institution plausibly operate outside this system? How could an Islamic finance exist and be profitable? Yes, you can exist, but you need to show me how you're making your profits. Because if you basically choose to not participate in this usurious game of this interest-based game, how are you going to make profits? I'm interested to know that. How can a financial institution secure funds that are Sharia compliant and free from usury? Where are your funds going to come from? Is it going to be fiat money or is it going to be commodity money? I want to know those answers, because when you come and say, this is a Sharia compliant, I have 100 questions for you to show me how can you separate yourself from this system, from this fiat digital money that we deal with today and is universal. If there was enough time, I would have presented to you how other countries in the world actually are issuing their money and how the monetary system works. So I think that would be too much. I don't think people can sit and listen for more than 2 hours. But solutions, quickly. So solutions. There are solutions on state and federal level, solutions on societal level, and there's solutions on individual level. But when we talk about state and federal level, we need to go back to full reserve banking. Okay, we need to criminalize the creation of unpacked paper money. Okay, that needs to be criminalized. Reversion to commodity money. We need to actually go back somehow to deal with commodity money, something that you cannot create, multiply, and it has a limit. Maybe someone will an idea will pop up, and someone will think about something that exists today that has some of those characteristics, and we need also to have like serious tax system reformations. On the societal level, we need to have education to our people about the monetary system. This is very important. You need to know, because otherwise you're just going to be taken advantage of. And we need to have mass reversion to cash. That's, I think, is one way to stop the banks from exacerbating inflation. And we need to find alternatives for banks, for people who want to do businesses and want to buy properties or something. An example of that is the crowdfunding. On individual level, we need to have taxation system education. We need to understand how the taxation system in this country works. And we need to actually try to preserve our currency in commodity as much as we can. But when you do that, you need to look at taxation system, because taxation system, as I said, it's also continuation of this unfair system, unjust system, that basically stops you from protecting and preserving the value of your money if you want to convert it to commodity, because the taxation system will punish you for that. If you decide to own property and participate in this mortgage loan process, okay, it's up to you. But I just can give you one simple advice, but please don't take it for granted. Go and do your own research, but don't go and buy an established home. That's the worst thing you'd ever do. Self-managed super fund. That's another way. How can people think about managing their money? Okay, and maybe investment in foreign countries with different taxation systems. That's always an option. Quickly, just touching upon this lady here, which is the the head of the Reserve Bank of Australia. She just announced a few days ago about the interest rate, the cash rate for December 2024, and they kept it at the same high. The government, instead of relying on interest rate hikes that reduces the purchase power and make people less capable of affording things. This is basically what they say. We only can counter inflation by increasing interest rates. And also the other mean, according to these very famous financial concepts called the Phillips curve, that suppressing employment, you basically make employment less, because when more people are employed, more people have wages, more people can buy things. So the only way they think and they convince us it's the way to reduce inflation is to limit people purchasing power, to make the money in your hand less by increasing interest rate and making your ability to afford things and buy things and provide for yourself and your family less by not increasing employment above a certain level. And you can see from this curve, the more unemployment decreases, okay, the more inflation increases. That's according to this. So instead of the government doing this, how about that the government goes to full reserve banking? How about cutting taxes, okay, and reverting to a gold standard? With all these measures put together, people can provide for themselves without being subjected to these pitfalls of debt-driven monetary policies. So basically, the solutions that can be just summarized here is that we need to encourage people to have cash withdrawal to pressure the banks. Because with less cash withdrawal demand, the banks can have no pressure. They can just go and practice this lending and borrowing and money multiplication without any obligations. Other thing is that we need to, through laws and legislations and politics, we need to call for a transition to full reserve banking. And also, we need to criminalize quantitative easing. What happened during COVID was a crime in my own eyes. Okay, yes, it was helping people to go through some hard times and everything, which I understand. But on the other hand, it was done in the most severe way that it will harm those people that you fed for 2 years or so. It will harm them on the long run. It will harm future generations. So everyone will be paying for this stupid thing, and it should not be practiced anymore. Like these security bonds and treasuries being issued, the RBA goes and buy them and all these things. This should be criminalized. We should stand in front of the government, tell them, don't do that, and whoever do that, that has to be put in jail. Additional measures that we should do or we can do is like education. We need to have accountability of the central banks. They need to be able to engage with the society in conversation and dialogue. And we need to somehow go back to the gold and commodity-backed currencies. However, the big banks will not want that to happen, because this basically will just affect them. They are the biggest winner of this system. So they will not stand there silent while anybody is trying to do that. But basically, that's a gradual process of decreasing this or reintroducing this SDR to 50% as a gradual shift toward 100% SDR, combined with lower interest rates and reduced taxation on businesses. This hybrid approach balances this restrictive nature of high SDR with the stimulative measures that aimed at mitigating the adverse effects on growth, employment, and banks' operations. And this is just a comparison of how can this combination of 50% SDR, low interest rate, lower taxes on businesses, what would be the expected outcome, and how can this affect inflation, property prices, employment, economic activity, and of course, bank revenues are going to be the worst. But I don't think I'm interested in banks' revenues. I think the most evil institutions ever. I don't believe any of you is interested in them unless you work for one of them. but I think that's what we can do. As you know, we are here, we're trying to do something to make this place better for us and for our, inshallah, children. So that's basically what I want to talk about. There was another part talking about currencies in around the world. There's different kinds of currencies. I think it will be just you can look at the presentation, inshallah. I will circulate this presentation when people, depends on what people's feedback and what they want. But I think this is for this session, inshallah. If there is a continuous interest in this topic, there are things that we can talk about, like usury cases study in Australia, that game of buying property and participating with these mortgage loans and this corrupt system. If you want to play it, there is a way to play it, like if you want to stay out of it, that's fine. But if you want to play it, there is a way how you can play it. Taxation system, this is important. We need to educate ourselves about it. And questions like, is Australia actually a good country to live in financially? And superannuation. So with very, very nice words from people. Thank you so much. Appreciate it. Barakallahu feekum. Very comprehensive presentation. Inshallah. Jazakallah khair. We need part 2. All right, inshallah, I'll try to run some survey to get from you guys feedback, and who is interested about which topic, who want to know more. And inshallah, we can, open the conversation with the broader, the broader community